Hello and welcome to our first full episode of the Credit Academy. Now, on today's episode, we're going to be discussing what credit is exactly and how it works. So be sure to stay tuned for the details. Just a quick disclaimer before we get started. Remember, just because you can buy now and pay back later doesn't necessarily mean you should. There is going to be a credit limit with any type of credit card you get, but just because it has that limit doesn't necessarily mean you should always go up to the limit. Actually, in a lot of cases, that can lower your credit score. So we're going to set aside a separate, video topic just for credit utilization rate. But before we jump on into credit, just make sure you're only utilizing around 30% at maximum of your total available credit. That way, you're not considered as high risk. So let's jump on into it. Starting off with the first question, what exactly is credit? Well, credit gives you the ability to borrow money. Now, this money is things that you can use for transportation, housing, credit cards, loans, etc. And this is with the understanding that you're going to pay back all the money you use on your lines of credit. So sometimes you have to pay an extra interest, is what we call it, that APR rate, when it comes to your payback. So just because you say you spend $100 within a month doesn't necessarily mean you're paying back $100, because if that APR rate is high enough, you could be paying up to $110 back because of that initial interest rate. Another thing to consider when it comes to credit as well is lenders, merchants, and service providers will grant you new lines of credit based on your score and how you use your already existing lines of credit. They take in a majority of factors, including, if you pay your bills on time, how frequently you use your card, in addition to kind of like what I mentioned previously, your overall utilization rate when using your new lines of credit. Diving on into the second question of how exactly credit works. Well, even before you get approved for new lines of credit, lenders will look at your credit history to see if you're a responsible and credit-worthy candidate for their said credit cards. Now, this once again takes in a variety of factors, but the one kind of main factor they look at is your credit score. What exactly makes up your credit history then, which is a large portion of your credit score? Well, there are three major credit bureaus. You have one Equifax, two Experian, and finally three TransUnion. And all three of these major credit bureaus will compile all of your credit activity into what is called a credit report. Now, a credit report is essentially a detailed breakdown of all of your lines of credit and all of your payment histories for said lines of credit. You may be wondering where your credit score comes into play when we're talking about credit reports. Well, as you may remember from what I previously stated, the credit report is that detailed breakdown of all of your kind of credit-related finances, and your credit score is kind of at a glance, your credit report. So when lenders are kind of considering you for an application, instead of looking at your detailed credit report, they'll look at your credit score as kind of a ballpark estimate of where you at for creditworthiness. I did mention those three kind of major bureaus previously. There is a note to take into consideration here. Your credit score is not going to be the same across all three of those bureaus. It will be different, and the reason for this is the way your lenders report their information. They have the choice to only report to one, two, or all three of the credit bureaus if they choose to. So it is important to look at all three of your separate credit scores, and even into a addition of this as well, there are going to be multiple scoring models when it comes to your credit. So you want to make sure you stay the most up to date with what your FICO and your Vantage scores are. So more of that to come in future episodes. Going back to your credit report, what other types of information can you expect to find there? Well, you're going to have things like your current credit accounts that you own, as well as their current borrowing limit and your current balances. So if you also have any existing loans that you haven't paid off, they will appear there. Now, kind of remember that fact. If they're paid off, they won't appear on your credit report. That is why in a lot of cases, you'll see people who pay off their mortgages or auto loans early see that they actually had a decrease in their current credit score. So if at all possible and you feel comfortable, definitely stick to your payment periods and try not to pay off any of your loans early unless you're willing to take that credit score hit. When it comes to the most important factor of your credit report and subsequently your credit score, it is going to be your payment history. Now, this represents a whopping 35% of your total FICO credit score. So it's a very important category when it comes to judging your credit worthiness as well as improving your credit score. Now, what exactly is payment history then? Well, essentially payment history is going to be your history of paying your, new lines of credit or your current lines of credit on time in full. So if you even make one missed payment or even late payment, it can drastically affect this category, which is why a lot of people, whenever they even just have one of those missed payments, sees that their credit score dropped a significant amount. Now, in addition to this, things like bankruptcies, foreclosures, or car repossessions also fall under this category. So, since this is the most and heavily weighted category, if you have any of these three kind of major credit report inquiries, they can also drastically lower your credit score. That isn't to say they are permanent though. These, depending on the amount of years, because they're different for each one, will eventually fall off, which we'll also discuss in a future video. Moving on, what are some of the types of credit? Well, of course you have credit cards, which fall under the most common category of being revolving credit. Now, this category will typically have a borrowing limit and you'll have to make a minimum of at least one payment a month, but you can pay more in full if you'd like as well. And if you don't pay in full, remember, just like the name implies of revolving credit, it revolves and carries over into the following month. So credit cards, once again, are kind of the prime example here of being the most popular form of credit in the revolving credit category. Moving on, we have what is called charge cards, which function similarly to credit cards, but they don't revolve and carry balances over. So you have to pay them off within the specified month as soon as you get the bill. Also, moving on, we have what is called installment credit. So with installment credit, these are going to generally be the most common category for loans. Things like student loans, car loans, or mortgages will all fall under this category. Also, under this category, you agree to pay a certain amount, aka a down payment, plus interest and fees over a small period of time. Finally, why exactly do you need credit? Well, a lot of people want to purchase a house, especially when they're younger, or maybe even a car, but they can't afford to pay it in full cash. Now, cash, especially these days, is very difficult to make a lot of these purchases because you need so much of it. Well, that is where your credit score can come in handy. Things like mortgages and car loans allow you to get what you want a lot earlier than you would otherwise, as well as giving you a new avenue to pay, whereas you're not having to spend a bunch of money in just one sitting. You can instead extend it over a period of time. Also, it really pays to have a good credit score. You'll save a lot of money when it comes to using loans in the long run. You'll save on interest fees as well as loan terms, credit limits, and other types of credit products as they become available. Not only does your credit score kind of gatekeep a lot of apartment options for you, but it can also dictate in some cases whether or not you will have to put down a security deposit. If you have a high enough credit score, some landlords will see that as a reason not to require a deposit from you. Also, some employers will factor in your credit score when it comes to the application process for some jobs. That's why we recommend as early as possible to begin building and starting your credit journey. Or also, if you have a lower credit score, start credit repair now. It takes time, and as soon as you take that first step, you're one step already ahead of getting a better credit score. To kind of cap things off, remember, credit is there to really make your life easier. But in order to do that, you need to know how and when it works. So it really helps to have good credit because, once again, a lot of things are kind of locked behind a credit score, almost paywall, if you'd like to call it that. Getting your first home, you'll be able to do that a lot earlier if you have a good credit score. Also, getting that nice car too. Getting an auto loan, that is also locked behind a credit score. But above everything else, remember, don't go overboard. Really manage your utilization limit and try to never go up to your credit limit. Remember, that can lower your credit score. So stay tuned for the next video where we're going to be going over in more depth the credit bureaus and how they kind of factor into the credit landscape itself. So stay tuned for that. My name is Michael, and you have been watching the Credit Academy. Thank you guys so much for tuning in, and we hope to see you guys in the next one.